Starting a business is exciting. You've got ideas, energy, motivation, and big dreams about growth. Everything feels possible in those early days. But here's something most startups don't realize early enough. Most small businesses don't fail because the idea was bad. They fail because the basics were ignored, and compliance is one of those basics. I've seen this pattern over and over again. Businesses doing well, money coming in, clients increasing, and then suddenly, problems. Not because the market changed or competitors showed up, but because of simple compliance mistakes that could have been avoided. Let's talk about the most common ones, honestly and without judgment. So you don't repeat them. One of the biggest mistakes startups make is saying, "I'll register later." Many entrepreneurs start trading before registering anything because they feel they're just testing the idea, want to avoid admin stress. Think registration is expensive, or assume that South African Revenue Service will only care when the business is big. So money starts coming in, usually into a personal bank account with no records, no tax number, and no structure. The problem is simple. Income is taxable whether you are registered or not. By the time SARS catches up, and they always do, you're dealing with backdated tax, penalties, interest, and stress you never needed. Registering early doesn't complicate things, it actually protects you. Another common mistake is confusing turnover with profit. Many startup owners proudly say, "My business made are 300 this year," but when you ask about expenses, there's silence. Turnover is not profit. While SARS taxes profit, VAT and many compliance decisions are based on turnover. Startups often underestimate turnover, miss VAT registration thresholds, submit incorrect returns, and get penalized later. The solution is simple. Track income properly from day one and understand the difference between turnover and profit. They are not the same thing. Failing to file CIPC annual returns is a silent business killer. Startups register companies and then forget about the commission entirely. In the first year, nothing happens. In the second year, there's a warning. By the third year, the company is deregistered. Once that happens, bank accounts can freeze. The company doesn't exist legally, you can't invoice properly, and credibility disappears instantly. Even if the business is still trading, filing annual returns every year, even when the company made no income, prevents this entirely. Many startups also ignore beneficial ownership BOE filings, often because they don't even know the requirement exists. CIPC now requires companies to declare who owns the company, who controls it, and who benefits from it. Without both filings, your annual return cannot be submitted and your company becomes non-compliant. Keeping both details updated yearly is no longer optional. Mixing business and personal money is another extremely common mistake. One bank account is used for everything. Personal spending, business income, cash withdrawals, and random transfers. From a compliance point of view, this is a nightmare. When SARS audits, they can't tell what's business and what's personal. They may tax everything, you lose deductions, and your credibility suffers. Opening a dedicated business bank account, even if you're small or a sole proprietor, makes compliance easier forever. Many startups also fail to register for the correct tax types. They register a company and stop there, forgetting about provisional tax, PAYE, UIF, or VAT. When thresholds are met, then one day SARS sends a letter stating that registration was required years ago, and suddenly there are backdated obligations, penalties, and interest. Understanding your business activities and knowing when each tax type applies prevents this problem entirely. Another dangerous mindset is believing that SARS won't notice. Some entrepreneurs assume SARS only audits big companies, that small businesses fly under the radar, or that cash businesses are invisible. They're not. Banks report, clients report, payment platforms report, CIPC reports, and employers report. The system is far more connected than people realize. Assuming visibility because you are visible is far cheaper than dealing with penalties later. Many startups also delay bookkeeping until tax season. Receipts are missing, bank statements aren't reconciled. Income isn't tracked properly, and expenses are guessed. When it's time to submit returns, panic sets in. Mistakes happen, numbers don't match, and penalties follow. Monthly bookkeeping, even if it's basic, prevents this stress completely. Not keeping documents is another costly mistake. SARS requires records to be kept for at least 5 years, yet many startups lose invoices, delete emails, misplace contracts, or throw away receipts. When an audit happens, no proof means no defense. Going digital, scanning receipts, using cloud storage, and keeping organized folders makes compliance far easier. The most expensive mistake of all is waiting until there's a problem to ask for help. Many entrepreneurs only seek assistance when accounts are frozen. Penalties are high, companies are deregistered, or deadlines are missed. Fixing compliance after damage is always harder and more expensive than preventing the problem. In the first place, early guidance, even a short consultation, can save thousands. Compliance mistakes don't make you a bad entrepreneur. They make you an uninformed one. The good news is that every mistake listed here is avoidable. And once compliance is handled properly, business feels lighter, less stress, more clarity, more opportunities, and more confidence. That's the difference between hustling blindly and building intentionally. And that's what the organized entrepreneur mindset is all about.